Get ready, folks, because what we're looking at today isn't just a regular market correction. It is a systemic, mathematically calculated market shock.
Real quick legal disclaimer up front, this is not financial advice. We're strictly here for educational purposes, and obviously, investing involves the risk of loss. Okay, let's get straight into it.
Jerome Powell is about to pull the rug out from under this entire market, and today I will show you the exact data proving Wall Street is already shorting tomorrow's meeting. Now look, you might think a rate cut is coming, right? Weak retail sales are dominating the news cycle. But check out this baseline expectation. The market is pricing in a measly 17% probability for a rate cut. Retail is completely offsides here.
Because the underlying truth, we're staring down $120 oil.
Combine that energy shock with a stubbornly high 156K ADP job print, and Powell is mathematically locked into a hawkish corner. Stick around until the very end, because I am going to reveal the exact physical hardware institutions are using to survive the Fed's middle finger.
Section 1. The ground truth. Mechanics of the exit sabotage.
Look, we are witnessing the final, brutal moves of the Powell era. This delayed May 15th handover to Kevin Warsh is absolutely not routine. It is a trap that insiders are calling exit sabotage. To put this in fifth-grade terms, it's exactly like a tenant moving out of a house and intentionally clogging all the drains just so the next guy has to deal with a massive flood. Powell is literally leaving the water running while the house burns down.
So what exactly is clogging these drains? First, it's pure political theater. We've got Jeanine Pirro's DOJ probe over $2.5 billion in Fed HQ cost overruns, combined with Senator Tillis blocking Warsh confirmation. It's creating this chaotic two-pope scenario. And on the macro front, a Strait of Hormuz blockade has ripped 20% of global oil right off the market. Brent crude is soaring. This is a massive involuntary tax on the consumer, which makes cutting rates to help them out mathematically impossible. Section 2. Informational asymmetry. There is a massive disconnect happening right now. Elite allocators are playing a completely different game than the public. Retail traders? They're still out there blindly buying call options, staying aggressively long on enterprise SaaS because they actually think a pivot is coming. But the elite institutions? They're executing what's called the Powell poisoning trade, actively shorting that exact same software layer. And here's why. It's the software trap. These dead-heavy software companies were taken private using massive leverage. Now, they have to refinance at 8% or higher. And at the exact same time, their core revenue models are being entirely vaporized by AI cannibalization. JP Morgan is already marking down software-linked loans. These zombie companies simply cannot afford to refinance. Therefore, they are collapsing under the weight of higher for longer rates, meaning all those retail longs are just being served up as institutional exit liquidity. Section 3. The macro impact. The two-sided risk. Now, Powell himself tipped his hand on this two-sided risk. Listen to this quote. Powell might hint at rate hikes to prove he isn't political before he exits. Let that sink in. The broader market is desperately braced for a pause, but if Powell even whispers the word hike, he absolutely implodes a shadow banking system that is completely unprepared for a real recession. Let me show you exactly where this contagion starts. Look at this massive $3 trillion private credit market. Notice that massive 20% slice? That is entirely made up of highly vulnerable software loans. This is a massive shadow market that has never, ever been stress-tested by high rates. And guys, the cracks are already showing. Major players like Blue Owl, Blackstone, and Apollo are already gating redemptions. The friction here is brutal. Zombie companies cannot refinance, but they still have to service their debt. Therefore, private credit is fundamentally cracking. And you better believe the supposedly resilient labor market is the very next domino to fall.
Section 4. The ultimate payoff.
So how exactly are elite allocators front-running this impending crisis? It's called the SpaceX hardware rotation. Smart money is rotating aggressively out of digital software and dumping into physical AI infrastructure. Just look at the data flow here. The xAI merger, Terafab Robotics, and Starlink printing $8 billion in EBITDA with 9 million subscribers. The elite are fleeing to physical atoms over digital pixels. Because they are staring right at this absolutely staggering number, $2 trillion. That is the target valuation for the impending SpaceX IPO. This massive figure highlights exactly where the elite liquidity is currently hiding out. But here's the catch. You can't just go buy SpaceX directly yet, right?
So how are institutions front-running this? Through specific proxy hardware vehicles. They are heavily accumulating EchoStar, ticker SATS, which holds $28 billion in SpaceX stock, and Alphabet, ticker Google, which owns a solid 7.5% of SpaceX. This is the hardware moat they've designed to withstand a stagflationary shock.
In a financial system where the Fed is poisoning the well, what is the actual price of exit liquidity? Hit the like button, subscribe to the channel, and drop a comment below with your thoughts on the tickers mentioned.